Today, we're uncovering a pivotal event that shook the financial world long before Wall Street existed, the credit crisis of 1763. Grab your popcorn, sit back, relax, and enjoy an economic meltdown that rippled across Europe. Let's jump right in. Our story begins in the bustling city of Amsterdam, the financial heart of Europe in the 18th century. Picture this: canals brimming with ships, merchants haggling over exotic goods, and banks extending credit like there's no tomorrow. But let's back up a bit. The 7 Years' War, spanning from 1756 to 1763, was a global conflict involving major powers like Britain, France, and Spain. Wars are expensive, and this one was no different. Governments borrowed heavily, and so did merchants to finance their trade and war efforts. Enter Leendert Peter de Neufville, a prominent Dutch banker whose name would soon become infamous. Neufville was deeply involved in speculative trading, riding the wave of booming markets and extending massive amounts of credit. But as they say, what goes up must come down. In 1763, just as the 7 Years' War ended, the financial house of cards began to collapse. Neufville's banking house failed to meet its obligations, sparking panic across the financial markets. Banks and trading houses in Amsterdam and beyond were suddenly facing a severe credit crunch. The collapse of Neufville set off a domino effect. Financial institutions that were interconnected through loans and credit lines started to fail one after another. This wasn't just a local problem. It quickly spread to other European financial centers like London, Paris, and Hamburg. International trade came to a grinding halt. Merchants couldn't get the credit they needed to finance their operations, and trade volumes plummeted. The economic impact was devastating, affecting not just bankers and merchants, but workers and communities dependent on trade. So what can we learn from the crisis of 1763? Let's break it down. Interconnectedness and contagion. The crisis showed how interconnected financial systems can spread panic and failure quickly. Speculative bubbles. When speculation drives asset prices, the burst can be catastrophic. Importance of liquidity. Liquidity is crucial. When it dries up, even solvent institutions can collapse. Regulation and oversight. Effective regulation could have mitigated the risk by monitoring and managing speculative behavior. Fast forward to today, and these lessons are still incredibly relevant. From the 2008 financial crisis to recent market fluctuations, the ghosts of 1763 remind us to stay vigilant in our financial practices and policies. That's it for today's deep dive into the credit crisis of 1763. If you found this video interesting, make sure to give it a thumbs up and subscribe for more insights into financial history. Leave a comment below on what topic you'd like us to cover next. Thanks for watching, and until next time, keep learning and stay curious.